Hi everyone, so let's now take a look at the Phillips curve. So when it comes to the Phillips curve, it really just helps us to understand the relationship, the inverse relationship that exists between unemployment and the level of inflation. That's an inverse relationship because when inflation is high, unemployment will be low. When unemployment is high, inflation is likely to be low. Now, it was drawn up by Professor Phillips at the London School of Economics after he had gone through years and years of data regarding unemployment and inflation levels. And then he plotted a line of best fit. Let's just take a look at how that would actually look then. So if we put down inflation on our y-axis here, and we've got inflation as a percentage. Meanwhile, we have unemployment on our horizontal axis, and again, we represent that as a percentage. Okay, so the line of best fit went something like so. Now, this would be regarded as our Phillips curve here, and we can see that a high level of inflation, unemployment is very low, but likewise, when unemployment is high, well, inflation will be very, very low. Okay, so there's some interesting points to bear in relation to this, that we can also see that Keynesian policy, Keynesian economic thought regarding unemployment and inflation was really developed further given the findings of Professor Phillips. And if we just consider the real GDP and the price level and a conventional long-run aggregate supply curve for what Keynesians used to believe before Professor Phillips's work, then you could see it was essentially perfectly elastic, and then the long-run aggregate supply curve became perfectly inelastic. Okay, now this was then adapted for the fact that as you near further and further closer to lower and lower levels of unemployment, you will have higher inflation. And this, of course, is reflected in the adapted long-run aggregate supply curve, which will adapt the model like so, with that red line there. Okay, so this is really quite useful in terms of understanding the fact that the government can either pursue low unemployment or low inflation, or they must opt for a balance. So it really helps us to answer any sort of question regarding government macroeconomic objectives, because we can see there is a mutual exclusivity here, i.e. you can either go for low unemployment or you can go for low inflation, but you cannot do both. So therefore it's likely the economy will be balanced somewhere in the middle there. Of course, there's always a certain level of unemployment in the economy due to structural factors, as well as, of course, frictional unemployment, which is always present. Okay, but there we go. That's our first introductory lesson on the Phillips curve. I'll see you on the other side. Thanks for tuning in.